Drew Lipke didn't grow up on a farm, but he owns one now. And that has helped him commit to helping others own farmland, even if they, like himself, were not born into the business. Hi, I'm Dave Price. Drew is managing director for AcreTrader. After Proterra Investment Partners acquired AcreTrader last August, this new combo decided to put together a new option for investors, and this is one that offers some additional flexibility. Drew will explain what that flexibility is and why they wanted to prioritize that during our conversation this week. And he'll also explain why he believes what he is seeing across farmland is more of a plateau and not a problem. Well, Drew, good to see you. Thanks for being with us. How you doing?
Very good, Dave. Thanks for inviting me.
Of course. How's life in Arkansas?
It's great. It's a beautiful day here now, and wrapping up another school year for the kids, and it's been a good year for us.
Awesome. Hey, talk about your background a little bit because we want to get into this new fund and the ins and outs of how this works. But how'd you get to where you are?
Yeah, so I joined AcreTrader back in 2021. Prior to that, my entire career had been working in investment banking. Most of that was spent within sell-side equity research. So I previously covered building materials, aerospace and defense. I covered upstream energy for a time. And then in 2021, when Carter Malloy, the founder of AcreTrader, reached out to me about the opportunity here, I really jumped at it. I've personally owned farmland in Arkansas. I will say it's much more recreational focused than production ag focused. But I really appreciated the asset class and really liked the accessibility to the asset class that AcreTrader was building. So I've been here for the last 5 years now. Rob Moore and I are the two individuals that really run and lead the platform. We're now, wholly owned by Proterra. And it's been a really fun 5 years. It's been a lot of exciting times, going through a lot of different cycles here, through different ownership structures, and it's been a lot of fun.
How'd you get into farmland ownership yourself?
So I'm a big duck hunter. And if I grew up in Little Rock, Arkansas, and training dogs is a big hobby of mine. And so my goal is to always make sure that my dogs are picking up as many birds as possible. And so we always leased a lot of hunting ground, but the appeal of being able to own ground and then build out, more leased acreage around it for hunting, and then also have the income from the farming as well and leasing out that farm ground. That's why I say when it was recreational, it was very much recreational focused for me personally.
But you didn't grow up on a farm, right?
I did not. No, grew up in Little Rock. And yeah, prior to coming to AcreTrader, my entire background is in finance. So sell side equity research, we were the guys that put out, the buy, sell, hold reports on companies. It was our job to be experts on an industry and experts on, 15 to 20 stocks within that industry and advise investors, typically institutional investors, on how they need to position their equity holdings for that industry. And so coming from, sell side equity research, public equities where the market is incredibly efficient, to a market like farmland where I would argue is extremely inefficient, that was a really attractive transition for me personally. And then being able to bring a lot of the discipline and the underwriting that I learned in my previous career and apply that to farmland as an asset class has been, an exciting transition and something that I think we've done pretty well over the years here.
I would suspect that this helps with conversations as you're talking to folks who have no direct upbringing in ag, but are curious about the investment side. Since you personally have gone on that journey yourself, that's got to help, right?
Yeah, absolutely. I mean, trying to relate the asset class of farmland to equities, to fixed income, to other, real estate
Hmm.
investments, it doesn't purely sit in any one of those boxes. I think if you go back to the pre-2022 timeframe, a lot of people viewed farmland as a bond replacement because you're picking up, low single digit yield off the income, plus you have the appreciation component. And frankly, I think that's the wrong way to look at it. The returns that have come from farmland historically have been through the capital appreciation of holding the land over time, right? Farmland's historically appreciated by 5.7% on average with very low standard deviation, about 5.2%. I mean, there's been very limited volatility in farmland and very limited drawdowns. And so it is that kind of safe capital base. But explaining to people that, look, the return profile really is through the appreciation because of the underlying supply demand dynamics that exist within farmland and the scarcity of the asset and the demand for and on that asset. Being able to put it in terms of, okay, how should I think of this in terms of my equity portfolio, my fixed income portfolio, my real estate portfolio? A lot of people try to compare it to gold because of the inflationary hedge characteristics that it has. I think there are some similarities there, but with much lower volatility when compared with gold. Then also you get the income component with farmland that you do not get with an asset like gold that's just pure capital appreciation. But it's been fun. We have many thousands of investors on our platform, and they're all different shapes and sizes and considerations and what they're trying to achieve. And so, educating them on this thing that they may drive by or fly over all the time, but never really gave consideration in terms of the wealth creation effect that it can have, is always a fun conversation to have.
Okay, I'm still hoping I'm going to find gold in my backyard, but I know there's not a farm back there. So would you say one of the top line benefits you talked about scarcity, is scarcity going to continue to be one of the prime drivers in why we are seeing this historic appreciation that keeps hanging in there? I mean, maybe it's slowed down in pockets the last year or two, but by and large, there seems to be a lot of optimism that this can continue.
I think scarcity is the key component. I mean, that's continuous shrinking of supply. I mean, if you look at the USDA data, the census data, we lose something like 4.8 acres every minute of cropland in this
Mhm.
country. And it doesn't trade hands very often. And I mean, you see this when you look at, anecdotally look at certain auctions that take place where a farm that hasn't sold for decades or generations all of a sudden comes up for sale,
Mhm.
and it's eyebrow raising numbers that people are willing to pay. And these are other operators that are stepping in for that opportunity. And that scarcity is the driver there. A lot of people believe that this might be the one shot I get at that property, and I need to bid as aggressively as I can for it. And you mentioned the last couple of years being softer. I think that's a good testament to the resiliency of farmland as an asset class. If you were to go back to the second quarter of 2022, and I were to tell you corn and soybean prices are going to be down 50% in terms of their
Mhm.
drawdown, input costs are going to be up north of 30%. And the Fed's going to raise rates at the fastest pace in history, where
Yeah.
operating lines of credit are going to, like, interest rates are going to increase by 3x on those. A lot of people would say, gosh, that's a really bad scenario for farmland values. And that has not been the case. And again, it goes back to that scarcity component. And a lot of people try to put, things like an earnings multiple on farmland and say, gosh, it's overvalued right now. Well, I don't know anybody that puts an earnings multiple on gold or other items like that have no kind of earning component to them. And again, it goes back to that scarcity component.
You talked about AcreTrader a little bit. Will you talk about AcreTrader and Proterra?
Yeah, yeah, absolutely. So we were founded back in 2017 by Carter Malloy,
Mhm.
and the
On the
original
AcreTrader side. Sorry to
on the
interrupt.
AcreTrader side, yes. And the original premise was to make access for farmland democratized and available for high net worth individuals. And that was something that, I think we've done very well and proved out that case over time. Acres was backed by venture capital, and AcreTrader continues to be backed by venture capital, the previous parent company. And they had a number of things that they were doing. Enterprise SaaS software. If you go to acres.com, you could see the example of this. It's basically a data business through a mapping interface that's more of a software business. And we lived under under the same umbrella between the asset management arm and the software arm. And it made sense for us to split apart. We needed somebody that wanted to invest resources within the AcreTrader asset management division, and they had the resources to continue to grow the software division. And so in August of 2025, AcreTrader, the asset management business, and then the entire team was acquired by Proterra. which is headquartered in Minneapolis. Proterra spun out of Cargill. They were previously Black River Asset Management, which was the internal asset management arm for Cargill. And in 2016, the team that is now Proterra did a management buyout, and they invest throughout the food and ag supply chain, whether that be private credit, growth capital, triple net lease. They've always invested throughout the ag supply chain because of the Cargill relationship, and they've always also invested in farmland. However, their farmland investments have always been international. They've had investments down in South America and in Australia as well. And I think after kind of a sunsetting provision of not wanting to compete in the United States, they wanted to get back into United States farmland. And we kind of came along looking to potentially explore some alternatives to live with more of an asset management focused group and be owned by an asset management focused group. And it was a cultural fit. And AcreTrader here in Fayetteville, Arkansas, really we just moved across the street and we are now wholly owned by Proterra and represent the farmland investment platform for Proterra.
All right, excellent. All right, let's talk about this new fund. How does this work?
Yeah, it's an important thing that it's a capability that Proterra brought to the platform, right? They've been running institutional capital for decades, and it's a strength and a skill set that they have internally. And so when you think about the investments on the AcreTrader platform, historically we stand up an entity, and that entity's sole purpose is to own and operate a single farmland asset. Investors invest as members of that entity, and we manage it for them. And it's as direct ownership to farmland as you can get on a fractional basis. That is a very good structure, and we're going to continue to offer that today. We have, again, many thousands of investors who like to build their own farmland portfolio where they
Hmm.
can have exposure in the Corn Belt and the PNW and the Mississippi Delta and the coastal plains and build their portfolio as they see fit. We also have received a lot of requests over the years of investors saying, look, I don't pick stocks. I sure don't want to have to pick farms. I have no
Right.
idea what I'm doing there. I
Yep.
don't want to get multiple K1s. And how can I, have a single diversified vehicle and make these investments? And at the same time, we had a lot of members from the wealth management channel. So think RIAs and financial advisors who would reach out and say, I love what you guys are doing. I believe in the asset class, believe in the thesis. How do I invest on your platform? And our solution was not a suitable one for them because of certain rules that RIAs need in terms of holding client custody assets within their own custodian. And so after the acquisition of Proterra, we worked quickly to build a fund, which is now an evergreen fund. It's called the Proterra AcreTrader Farmland Fund, and it provides diversification within a single investment vehicle. The assets are actually held in a private non-traded REIT. So there are some tax benefits where investors get a QBI deduction from the Section 199A of the tax code. So it lowers the taxable basis for investors on the income that's distributed. It gives that diversification. It gives some additional liquidity benefits in that there's a 24-month lockup after investment. So your capital's locked for 2 years. And then after that, if you would like to redeem, you can request redemptions on a quarterly basis, and liquidity is then managed very specifically to match the asset class. And so that diversification benefit, the potential for a greater liquidity benefit, and then getting a single K1 benefit, those are a lot of pain points that we had from different groups of investors over the years that we wanted to be able to address. And this fund product provides that. And in addition to that, we do provide a net asset value on a quarterly basis. So you get to see where your position stands every single quarter. And we've built the infrastructure where if you're an RIA, that reports back into your back end system. So you can see your equity holdings, your fixed income holdings, and then your allocation to this farmland fund and how it's tracking relative to those other investments.
How you mentioned you have 24 months. There are other ones, as you know, that may lock you in for longer than that. Why do you have that short time frame?
So a couple of reasons. We wanted to balance, like with our direct entity investments, you're basically your capital's locked until the farm is ultimately sold. And
Hmm.
those are, 5 to 10 year hold periods. So that is much lower liquidity when compared to this. because this is going to have a diversified portfolio, because this is always going to be able to raise capital and bring in new investors to then liquidate existing investors at that given NAV, and because we're running an unlevered fund where we have the ability to use leverage to also meet redemption needs, we felt like, okay, a 24-month lockup that allows us the ability to manage liquidity on a quarterly basis as needed and still bring in new investors to meet liquidity needs. And so we felt like it was the proper balance of providing liquidity, but the key is it's got to be managed liquidity, not forced liquidity. And so we're just very thoughtful in how we structured this. Proterra's got a number of other evergreen funds within the private credit side and within their net asset value side, and then obviously the legal counsel that we worked with. We kind of took the uniqueness of the asset class, the more illiquid nature of the asset class, and said, how do we marry the need for some liquidity with that? And ultimately, we felt like a 2-year lockup was the appropriate time frame that will allow us to manage those liquidity needs once they're needed going forward.
I'm fascinated by the mix. So how do you decide what that final mix? Like you talked about, maybe one of the appeals of this is that you're not all in on row crops, or you're not all in on whatever, but you figure out this blended mix. What's the secret sauce? What can you say about that? How is that determined?
Yeah, I mean, if you look at what we've done to date, so we target investment grade farmland, and that means different things, I think, to different people. But for
Hmm.
us, it means what we consider Class A or Class B ground in core farming regions of the country. And I'm sure people have other theses of investing in certain regions that we don't believe in, and are opportunities to make money in land for sure across different strategies. But what we
Sure.
do is our portfolio is about 40% in the Corn Belt, about 20% in the Mississippi Delta, about 15% in the Pacific Northwest. That's particularly the Columbia Basin and the Snake River Basin. And then the rest is kind of a mix between the Northern Plains, the coastal plains in Georgia and the Carolinas, and then the Lake States, and then a little bit of some pockets in the West Coast that we like. And we intend to replicate on a go forward basis the same portfolio that we've built to date with the fund's assets. And those are areas, as much as over the last 8 years, we've been marketing to investors to build awareness of the asset class and our approach to the asset class. We've also been marketing directly to operators. And we've built a very strong network where there are many instances where a farmer and operator has some kind of opportunity and they can't purchase that property themselves if they're capital constrained for any reason. And they need an investor to step in, or otherwise that farm will be sold and they'll lose that lease from their operations. That's where we could step in. I often jokingly say we're kind of 1-800, I need an investor. And so we fit a very specific, tool set for the operators that we work with. A lot of times an operator will have a landlord who's selling and they offer that to them first. And if they can't buy it themselves, they need somebody to step in. And that's been really a network that we've built and honed, and that's why we're strong in the regions where we are strong in. And I think we will continue to build out the portfolio across that same footprint that we have to date.
As you know, in the non-ag world, when we're talking about our retirement, we can we work with our advisor on, do we want be more aggressive, less aggressive? Maybe we work in our retirement when we think we're going to retire, whatever, and in our personal comfort level, all that kind of thing. Can you work in risk at all with this? If you see greater potential in a segment, can that work into the mix here?
From an assets across asset standpoint between equities, bonds, and farmland, yeah, I think step one is make sure you understand the liquidity profile of farmland. Whether you're investing with us, whether you're doing it yourself direct, it is not a liquid investment, and so
Hmm.
you're parking capital for a long period of time. And if you need to pull on that capital, you're not going to be able to, whether it's with us or whether you're doing it yourself.
Sure.
So step one is make sure you understand that right out of the gate. Beyond that, when you look at the risk profile for farmland compared to other asset classes, and we have a good chart of this, the total returns of farmland have been roughly 9% over the last, going back to 1997, if you use the USDA data as a proxy. And the volatility of that has been a little over 5%. If you compare that, stacks up really well when compared to equities, when compared to fixed income, when compared to gold, when compared to other classes of real estate. It's that limited volatility and the lack of drawdown in farmland values that is a key consideration when you think about risk for the asset class. And so we would argue that farmland sits nicely as a lower risk alternative compared to more volatile asset classes such as equities and gold. And it still carries the same cash flow visibility and income visibility, and volatility profile of fixed income. And so I think it sits closer from a risk standpoint to fixed income for investors' portfolios as long as they understand that liquidity aspect.
As you're talking to investors and potential investors, kind of the curious group, how do you counsel them if they're watching international headlines? Is this, what we have going on in the Middle East? We're talking to you kind of in mid-May. So that's been going on for 2.5 months or so, a lot of uncertainty with there. We've seen what that's done to energy prices. We've seen what that's done to fertilizer. How do you counsel people when they're looking at, man, where are we going with this and how's this going to impact things?
Yeah, yeah, we get the question a lot. The most important thing is to differentiate between farmland asset values and the volatility of cash flows for leased farmland compared to production agriculture. It's really important. A lot of people try to lump those two things together. If you have a structure where you own unlevered farmland and you lease it out on a cash rent basis, your volatility is significantly less than obviously the volatility that we see within production agriculture. Production agriculture, I mean, that it's a commodity business. It's always going to be volatile. It always has been volatile. I can bet on that pretty confidently. I'm also confident that if you own investment grade farmland in the United States in these core regions, that through cycles, there's going to be a tremendous amount of operators who want to be able to farm that ground. The vacancy rate on high quality ground is zero.
Mhm.
And that just gives a much lower risk profile to the asset class. Now, certainly longer term, these things can impact, right? And when you look at farmland values historically, you typically see these run ups and then you see a bit of a plateau, and then you see a run up and then you see a bit of a plateau. I'd argue that we're in more of a plateau period. I mean, we saw a nice run up based on, net farm income was great in 21, 22. Farmers did exceptionally well. And then 23 and certainly 24, 25 have been much more difficult for operators. Certainly, there's a backstop there that we've seen from direct payments, and that helps provide a bit of a safety net to the overall production ag economy. But sustained downturns do lead to these more plateau periods. And if you look back historically, that's been a great opportunity to acquire farmland. And that's the approach that we typically take to it. And if you think about the first order effects of higher oil prices, now certainly what matters most is how long they stay high. And so that's going to be the key thing to watch. I mean, most of the operators we work with are professional operators. And, when we looked at it, I think something like 90% of their fertilizers and inputs were pre-booked and pre-bought
Sure.
going in, and plans were already set for this season. But if this continues into the fall, it will have a carryover impact. And ultimately, we think you got to look at the second order effect, which is, corn and soybeans are about zero point 0.7 correlated since the passage of the renewable fuel standard back in '07 to oil prices. And you're likely going to see, in concert with higher input costs, higher grain prices. And we've already started to see an initial leg up. There's a saying that wheat leads, and we certainly saw that with the WASDE report yesterday. So I could paint a very bullish scenario for higher commodity prices in 2027, especially when you stack up our competitive profile against places like Brazil, which is heavily reliant on imported fertilizer. And because of the soil
Mhm.
profiles they have there, they're very reliant on inputs, and it makes us only more cost competitive on a global scale. And so I continue to think that, high quality ground in places like the U.S. Midwest are going to win.
Safe to say you're an optimist. True. You're seeing some indications that maybe 27 is better.
Yes, yes, I would say that that's our belief here internally. Again, it doesn't really affect our farmland investments
Sure.
significantly. What we do try to do to capitalize on it, however, is we put in more flex leases anytime we can. If we can lower the base rent for the operator and have some kind of bonus rent or flex rent component where we get to participate on upside to commodity prices, we will put that in as much as we can because we are pretty bullish on commodity prices longer term.
We've talked about energy a couple times, and you mentioned that was your background. How are you viewing this national conversation we're having in certain communities where this kind of tension in the ag space about especially wind and solar, like whether that has a place there or whether it does not? That has been fascinating for me to watch in so many communities across the country. You have so many farmers who believe that this is a vital additional income stream for them. You have others who don't want to see it and they think that it's a blight on the area.
Yeah, so I covered upstream oil and gas, but I mean, I think it makes the most sense when you look at our existing production today, whether it be domestic oil production and certainly domestic natural gas production. I mean, we have a competitive advantage in the United States for that. We need to use that as a bridge to also then add more redundant sources of energy, whether it be solar or whether it be wind. I think that only makes sense to add in redundancy to such a critical component. And when you go through these shock events, like we're seeing here with the war in
Hmm.
Iran, I mean, the fact that we have the domestic production because of the shale boom that accelerated back in the teens, like we have that resiliency, and I think it only makes sense domestically for us to continue to build in resiliency to our overall, energy production. So I understand operators that don't want to see solar taking out cropland. I think, we typically see it more on marginal ground for solar production.
Sure.
Adding in windmills, or turbines, I think certainly makes sense where that's been a win. We have some properties that have turbines on them to generate some additional income, and the operators on those properties don't seem to have any issue of, working around that. I think it's a pretty minimal footprint.
All right, let's go back to the fund. Where is it drawing interest right now? Where's the new interest? And
Yeah,
granted, it's a
so
new fund, so that might be a little silly, but you know what I mean.
yeah. I mean, we're 4 weeks into it,
Yeah.
and I'd say so far, we do have this large existing investor base today of people that have trusted us from the beginning and built
Hmm.
portfolios with us from the beginning, and so that's certainly where we're seeing the most interest and seeing the most allocations at this moment in time is from our existing investors who want to continue to build their portfolio with us, and they like the fact that they only get one K1 as opposed to multiple K1s come season, and this is just an easier vehicle and the enhanced liquidity that I mentioned. So we're seeing a lot of adoption from our existing investor base. And then the next step is, we're talking to a lot of the wealth management channel. So, a lot of or most investors have somebody invest capital for them, right? You hire a
Hmm.
financial advisor. Most people don't do it themselves. That's the standard route, and we've had a lot of the wealth management world that we've talked to over the years that have wanted to invest with us and haven't been able to. And so now we're going back to those groups and saying, look, we've built this specifically for this channel and re-engaging those conversations. And it's been very well received so far.
Your background's so diverse, how you specialized in different areas at different times. What do you watch in the rest of 2026? Like, what gets your curiosity?
Oh, man. There's a lot to be curious about right now, right? I'm watching inflation. I'm kind of the belief that we're under a higher inflationary regime for
Hmm.
longer, and I
Hmm.
think the next move in interest rates is probably higher. Then I think it's going to be forced. Certainly I'm intrigued by the impact that AI is going to have on all of us, whether that be from an investing standpoint or from a personal standpoint. I've got 4, 6, and 8-year-old kids, and how they interact with it and learn from it, but still maintain the ability to think on their own.
Sure.
And don't outsource all your intelligence and your thought process to something else. We
Yeah.
certainly utilize AI a lot here internally, and you got to make sure you're not using that as a crutch, right? You got to make sure you're doing your own initial thought work and verifying everything. So that's something that's really, I think, going to be key for us over the next decade is how does this impact everyone? So that's certainly something that I'm watching. the equity rally that we're seeing today. I don't want to step out of my comfort zone here, but it's certainly being led by earnings growth from a handful of companies.
Yeah.
Valuations are at levels that would, from a long-term historical perspective, should make anyone nervous. Credit spreads are very low. It doesn't seem like in the public markets today, investors are being compensated for risk. And that's something that I nervously watch constantly.
A lot of things to watch for sure. Drew, appreciate this. Thanks for the conversation, and hope we can do this again sometime.
Absolutely, Dave. I appreciate it. Thanks for having me on.
Thank you. You can learn more about Drew, what he's done, what he's doing. It's all part of our profile piece about him, and you can find that in the American Farmland Owner newsletter. It's the place where landowners get their news. You'll find interviews with thought leaders, what makes some farmland highly sought after, plus the unique ideas that farmers, ranchers, and investors are bringing to this evolving industry. You can check it out right now at AmericanFarmlandOwner.com. Thanks for joining us here on the podcast, and thanks for caring about the future of our farmland.